Hi friends, welcome to the accountancy class. Today in this module we are going to learn about the important accounting concepts used in financial accounting. Accounting concepts refers to the necessary assumptions and ideas which are fundamental to accounting practice. The important accounting concepts are business entity concept, money measurement concept, going concern concept, accounting period concept, cost concept, dual aspect concept, revenue recognition concept, matching concept, full disclosure concept, consistency concept, conservatism or prudence concept, materiality concept, and objectivity concept. In this module, we are going to learn about business entity concept, money measurement concept, going concern concept, and accounting period concept. Business entity concept is also known as separate entity concept. This concept assumes that for accounting purpose, the business enterprise and its owners are two separate independent entities. Thus, the business and personal transaction of its owners are separate. The concept of business entity assumes that the business has a distinct and separate entity from its owners. When a person brings in some money as capital into his business, in accounting records, it is treated as liability of the business to the owner. Here, one separate entity is assumed to be giving money to another distinct entity, that is, business unit. When the owner withdraws any money from the business for his personal expense, that term is known as drawings. It will be treated as reduction of owner's capital and a reduction in the liability side of the business. In accounting, the personal assets and liabilities of the owner are not considered while recording and reporting the assets and liabilities of the business. In the same way, the personal transactions of the owner are not considered in the book of the business. Next concept is money measurement concept. This concept assumes that all the business transactions must be in terms of money. The concept of money measurement states that only those transactions and happenings in an organization which can be expressed in terms of money, such as sale of goods or payment of expenses or receipts of income, are to be recorded in the books of accounts. The examples of expenses are rent paid, commission paid, interest allowed, advertisement expenses, office expenses, salary paid, etc. The incomes or receipts of incomes are rent received, commission received, discount received, profit on sale of machinery, etc. Transactions which can't be expressed in terms of money cannot be recorded in the book of accounts. For example, appointment of a manager, capabilities of its human resources, creativity of research department, etc. The another important aspect of this concept is that the records of the transaction are to be kept not in the physical units but in the monetary units. Next important concept is going concern concept. The concept of going concern assumes that a business firm would continue to carry out its operations indefinitely. That means for a fairly long period of time and would not be liquidated in the foreseeable future. This is an important assumption of accounting as it provides the very basis for showing the value of assets in the balance sheet. Every business entity has continuity of life. Thus, it will not be dissolved in the near future. This is an important assumption of accounting as it provides a basis for showing the value of assets in the balance sheet. Fourth point is accounting period concept. Accounting period refers to the span of time at the end of which the financial statements of an enterprise are prepared to know whether it has earned profits or incurred losses during that period, and what exactly is the position of its assets and liabilities at the end of that period. At the end of the period, the accountant have to prepare various important financial statements. The financial statements are prepared at regular interval, normally after a period of 1 year, so that timely information is made available to the users. This interval of time is called accounting period. Thank you.